Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. So after we did our deep dive last week into the question of whether the senior deduction was an above the line deduction or a below the line deduction, do you know what happened? State taxing authorities started getting grumpy. Now let's do a pop quiz. Why would a state taxing authority care if OBBBA deductions were above the line or below the line? I see one hand in the back. Well, it's because many state income tax returns use federal AGI as the starting point to determine state taxable income. Let's look at an example. Here is the Michigan MI 1040, which is the Michigan individual tax return. By the way, have you ever met someone from Michigan? They put their palm up in the air like this right here, and they say, "I'm from here." I know. Weird, right? Must have to be from Michigan to understand that, but they are one of our 50 great states, so we still love them. Anyway, let's look at this particular section right over here of the Michigan 1040, which is where the state taxable income is determined. So what is the starting point of the calculation for determining taxable income right here for Michigan purposes? Well, it's right here, adjusted gross income, or AGI, from your U.S. Form 1040 federal tax return. This is a very common starting point for many state income tax returns. Another example, let's look at Arizona. Here's the Arizona Form 140, which is the personal income tax return. Right down here, what's the starting point for the Arizona state income tax calculation? Again, it's federal AGI from your federal tax return. So if the senior OBBBA bump of $6,000 per person age 65 or over, or any of the OBBBA provisions for that matter, are above the line, let's just assume for the moment for this example that they are above the line, then they would be included in the calculation of federal AGI and would therefore have the potential to impact the state's revenue and budget. Back up here to Arizona for a second. Do you follow what I'm saying? Above the line deductions impact federal AGI. Therefore, if federal AGI is the starting point for your state income tax calculation, then above the line deductions have the potential to impact your state taxes. Alternatively, recall that below the line deductions come after AGI on the federal tax return. Therefore, below the line deductions for federal would not have any impact on your state income tax calculation. Let's do an example. Right here we have a snapshot from our Form 1040 federal income tax return. Assume that you are married filing joint with both spouses age 65 or older and you have $100,000 on line 9 of the federal income tax return. Line 9 is going to be our total income on this tax return before any Schedule 1 subtractions, which are the above the line deductions. This line right here, number 10, Schedule 1 subtractions, these are the above the line deductions. And those above the line deductions, when subtracted from this total income, is how you arrive at AGI. Okay, so line 9 is all of your income before any Schedule 1 above the line subtraction adjustments. We just said that. Okay, now before OBBBA, considering just the items I've mentioned for this fact pattern so far, your federal 1040 would look like this. We'd have $100,000 right here on line 9. That's the income before the above the line adjustments. Right now we have not mentioned any above the line subtractions, so line 10 would be 0 on the federal Form 1040, and the result would be AGI on line 11 of $100,000. That's what we have demonstrated right over here. But after OBBBA, assuming an above-the-line subtraction for two senior OBBBA bumps of $6,000 each for a total of $12,000, your federal 1040 would look like this. We'd still have our same $100,000 of total income before any above-the-line subtractions. Remember, we are assuming for purposes of this example that the IRS is going to treat the senior OBBBA bump up as an above-the-line deduction. So under this fact pattern, we would have $12,000 of above-the-line subtraction right here on line 10, resulting in $88,000 of AGI on line 11. And that is what we have demonstrated right over here. And so what all of that means is that the starting points for your state income tax calculation for the large number of states that use federal AGI as the starting point to determine state taxable income, before and after OBBBA, the returns would look like this. Here's what the Michigan MI 1040 before OBBBA would look like with AGI on line 10 as the starting point of $100,000. And here is what the Michigan MI 1040 after OBBBA would look like with $88,000 on line 10, the adjusted gross income line. So Michigan, or any state that starts with federal AGI, just lost $6,000 of taxable revenue per state resident that is age 65 or older and isn't phased out of the senior bump by income. Now, how do you think the great state of Michigan is going to feel about that? Well, here's a little preview for you. That open palm that they used to have held up in the air, it's gonna turn into a little something like this, and they're gonna say, I'm from right here. So what Michigan may likely do, or any state that starts with federal AGI, is they will likely create an addback. An addback is basically the state saying, yeah, that's nice that you get that $6,000 per person deduction for federal, but we don't play that. So again, it's quite possible that Michigan or any other state that starts with federal AGI will make you add back OBBBA provisions if it turns out that they are above the line and therefore reduce federal AGI. And that would look something like this right over here. There's our AGI from the federal return under the new OBBBA provisions of $88,000 that we just saw above. Here's Michigan's additions. They also have a Schedule 1. Those are add backs to their tax return to increase state taxable income. In this fact pattern, we're just talking about the senior bump, so we had $12,000 deducted on the federal tax return above the line. Michigan would make you add that back most likely, and you would be back to the original $100,000, which is what your AGI would have been except for the fact that you got the new OBBBA senior bumps. Okay, now I know that some folks watching this video right now are like, wait a minute, we just determined in the previous video, right over here in the above the line versus the below the line comparison, that a number can't be phased out based on AGI or MAGI, which is just AGI with some modifications, and also impact the resulting AGI. That's where we ran into the circular calculation that we talked about in this video right over here. So how is it even a possibility that OBBBA provisions could be above the line and therefore impact AGI, thus causing the possibility that they become state addbacks? Well, here's what I want you to do. I want you to consider the above video to be the high school level explanation. And it's good to understand the high school level explanation, because after all, you have to be able to walk before you can fly. But for all of my number crunch nerd followers who have been keeping up with the OBBBA update videos, guess what? You just graduated. Yes, you will get a little hat. But the time has come for us to go to the college level explanation. We're gonna roll up our sleeves and get to the real nerd action, okay? This is where the real nerds are gonna party. But by the way, before we do that, I just thought I'd share with you some recent comments from members of the Personal Tax Planning Template Program. Right here, just an update on our journey with the Personal Tax Planning Template package. We have learned a lot about taxes, Excel, Roth conversion planning, and tax planning from your videos and PTPT package. The personal tax planning template package is what we have been looking for a while. And right here, you do such an excellent job of providing very valuable information that most YouTube channels just gloss over. Extremely glad I became a member and have mentioned it to several friends. Alright, so let's hop into the college level explanation right here. I want you to think about the traditional IRA contribution and deduction. Let's do a pop quiz. Can you contribute to a traditional IRA at any income level? And the answer is yes, you can contribute to a traditional IRA at any income level. However, can you deduct the traditional IRA contribution at any income level? And we're going to have a two-part answer here. The answer is yes if you and your spouse have no retirement plan coverage at work, but the answer may be no if you do have workplace retirement plan coverage and your income is too high. Okay, so scenario one, let's assume that you can deduct a traditional IRA contribution under your fact pattern. Where is the deduction located? And the answer is it's located on Schedule 1, which means above the line. So right here is our Schedule 1 from the Form 1040. We're right over here on page 2. And then right down here on line 20, there is our above the line IRA deduction. Let's just say for this example that it's $7,000. Okay, now what happens at the bottom of this page? We're still on page 2 of the Schedule 1 right here. What happens right here on line 26? It says add up lines 11 through 23 and 25. So if we back up, lines 11 through 23 include line 20 right here. These are your adjustments to income. In other words, these are your above the line subtraction adjustments. They get totaled up right here on line 26. And then from here it says enter here and on Form 1040 line 10. So going back down to our 1040 snapshot, there is line 10. There's the adjustments to income from Schedule 1, which we have already said are the above the line subtractions. In this case, we only have one item in question, so there is the $7,000 above the line IRA deduction. Okay, so if the traditional IRA deduction is included in line 10 of the 1040, then it is clearly above the line, therefore impacting AGI. Everybody with me? Okay, now let's get tricky. Scenario number 2. Assume now that you can't deduct the traditional IRA contribution or that it is partially phased out based on your income. In other words, you can only deduct, let's just say $2,000 of your $7,000 total traditional IRA contribution. So for example, there's now $2,000 on these lines. $2,000 on line 20 of Schedule 1, and that $2,000 is carrying to line 10 of the 1040. So we have basically a $5,000 phase out of your IRA deduction in this example. And my question to you is, what was the phase out of your IRA deduction based on? And the answer is, well, it was based on MAGI. Let's go right down here to this IRS table for the 2024 IRA contribution and deduction limits. Right here, just as an example, if you're married filing joint and your modified AGI, your MAGI is more than this number but less than this number, you're going to get a partial deduction or you're going to get a partial phase out. For purposes of today's discussion, I'm not concerned with the amount of these numerical thresholds. I'm also not concerned whether this is 2024 or 2025. What I want you to focus on is that this was phased out based on your MAGI. Okay, now hold on. I know my smarties out there are starting to put it all together. You're saying, wait a second, if MAGI is just AGI adjusted for various modifications, how can the IRA IRA deduction be phased out based on MAGI, but then also impact the AGI starting point, which we clearly saw that it did because it's an above-the-line deduction. Isn't that how we kept running into the circular calculation in the last video on the above versus below the line issues questions? Something about this situation is not making sense. Well, here's the answer that's going to put it all together. The traditional IRA deduction itself is one of the modifications to arrive at MAGI. Okay, stay with me now. Let's check it out. Here is the IRA phase-out calculation from IRS Publication 590A. It says, use this worksheet to figure your modified AGI for traditional IRA purposes. And then right here is the key. Enter your AGI from Form 1040, line 11, but pay attention now, figured without taking into account the amount from Schedule 1, line 20. In other words, it's saying start with line 11 AGI, which we already know includes the impact of line 10. So we know that whatever number is going to be right here on line 11 is already $2,000 less than it otherwise would have been in this fact pattern, due specifically to this above the line deduction right here. But then just remove from line 11 the part of line 11 that relates to the IRA deduction on Schedule 1, line 20. So one more time, they're saying take this number right here, which includes the impact of everything on line 10, but just exclude this amount which is on line 20 of Schedule 1. Did you follow that? The IRA deduction itself is one of the modifications to get to MAGI. You start right here with AGI from line 11, but just then as like a side calculation, you just take out whatever amount is on line 20 of Schedule 1 for the IRA deduction. Okay, here's the summary sentence. That's how you put an item, any item, whether it's an IRA deduction or a senior OBBBA bump or any item, that's how you put the item above the line where it will impact AGI while also still allowing it to be subject to phase out based on MAGI. You make the deduction itself part of the MAGI adjustments. This exact concept could apply to the senior deduction or any of the other OBBBA provisions if the IRS wants to put them above the line. Alright, so now put on those thinking caps because I'm gonna twist you. If the IRS puts the senior deduction above the line, so let's just say for this example we have $175,000 of total income before above the line deductions. The IRS has decided to include the senior OBBBA bump as an above the line deduction on Schedule 1, so that's going to be $12,000 in this example. That would make our adjusted gross income $163,000. However, this has been set up right here before determining any phase out of the senior OBBBA bump based on income, or more specifically based on MAGI. So if the IRS was going to go with above the line presentation, I would expect to see a worksheet similar to the one we just went over for IRA deduction purposes. It would probably say something like, use this worksheet to figure your modified AGI for senior OBBBA bump purposes. Enter your AGI from Form 1040, line 11, figured without taking into account the senior bump deduction from whatever line we decide to put it on Schedule 1. So let's go to our side calc. We have our AGI of $163,000, which comes from line 11 of the 1040. We add back to that, or we otherwise disregard the $12,000 of senior OBBBA bump that is sitting on whatever line on Schedule 1 the IRS decided to put it on. After we back that out, we arrive at $175,000 of AGI for senior bump phase-out purposes. We're going to assume that the rest of these items right here don't apply, like foreign housing deduction, excludable savings bond interest, etc., etc. We're just going to say the $175,000 carries right down here to the grand total MAGI for purposes of calculating this senior bump phase out. Now we already know from this video right over here that the senior deduction phases out at $60 per person for each $1,000 by which MAGI exceeds the phase-out starting point of $150,000 for this purpose. So we have $175,000 of MAGI, which we just determined above right here. We're going to subtract off the $150,000 starting point for the phase-out threshold for this purpose. That equals $25,000 by which we are over the limit, and we're going to divide that by $1,000, which equals 25 or 25 factors of 1,000 over the limit. Therefore, the phase out is 25 factors times $60 per person times 2 people in this example, or $3,000. Therefore, the senior bump in this scenario is reduced from $12,000 less the $3,000 right here that was phased out to equal $9,000. And therefore, we have to adjust our Form 1040 to reflect the reduced senior bump. So we still have the same $175,000 of total income. We now have a reduced above the line deduction for the senior bump of $9,000, resulting in an adjusted amount of AGI of $166,000. And my question for you is, AGI has now changed because the senior bump, which we are treating as an above the line deduction, does impact AGI, but do we have any circular calculation like we experienced in the last video? And the answer this time is no, because the senior bump itself is one of the modifications to get to MAGI for purposes of the senior bump phase out calculation. In other words, regardless of what the amount of the senior bump ends up being, AGI before considering the senior bump is always going to be the same. Here's a comparison of the side calcs. Here's the original side calc. We had $163,000 of AGI. We added back $12,000 of senior bump to arrive at $175,000 of AGI or MAGI, the starting point for MAGI on that form we just looked at, specifically for purposes of the senior bump phase out calculation. But now look at the updated side calc. AGI has changed to $166,000. We still add back whatever amount of senior bump has been allowed, in this case $9,000, and we arrive at the same $175,000 AGI starting point for the senior bump phase out calculation. By making the deduction itself, in this case the senior bump, but this concept applies to any above the line deduction, by making the deduction itself part of the add backs for MAGI purposes, that is how you can always arrive at the same MAGI starting point, allowing the deduction to be phased out based on MAGI, while also allowing the deduction to ultimately impact the AGI that appears on your 1040. Okay, now is the point where states like Michigan and Arizona and many others that use federal AGI as the starting point for the state income tax calculations may pop up and say, before OBBBA, there would have been $175,000 of federal AGI starting point to determine taxable income in Michigan, for example. So again, before OBBBA, Michigan would be expecting to see $175,000 right here. But after OBBBA, we, the great state of Michigan, are losing money. And we don't like that. So we're going to create a state modification to make you add back any senior bump deduction that you received. In this example, the add back would be $9,000 because that's the actual amount of senior bump that you received after the phase out. So we would take the $166,000 of AGI off the federal tax return. We would add back the $9,000 of senior bump, and the resulting taxable income for state purposes would be back to to $175,000. And that's the result that Michigan wants: taxable income for Michigan purposes being equivalent to what federal AGI would have been but for the senior deduction. Okay, now, if above the line presentation is where the IRS lands once the rules and regulations regarding OBBBA are finalized, here's what my followers need to do for state purposes. Since I certainly will not be able to make videos about the details of this for each and every individual state, if this ends up applying, you're going to want to Google search phrases similar to the following for planning purposes or when tax return time comes around. And the phrase would be something like, is the OBBBA provision for insert whatever provision is relevant to your query right here. Is it an add-back modification for purposes of determining state taxable income in, and then insert whatever the relevant state is right there. In addition to state-issued guidance on those questions, local and regional CPAs who practice in those states will likely have articles addressing this on their websites. So that summarizes how some or all of the OBBBA provisions could end up being above-the-line deductions which do impact AGI and thus impact the state starting point for many states, resulting in a whole slew of different rules on a state-by-state basis regarding what modifications may need to be added back to income for state purposes. So for members of the Personal Tax Planning Template Program, I have just put 3 update videos into the members area on the following topics. Update number 1, how to calculate MAGI. Everybody's been asking about it because almost all of the new OBBBA provisions are phased out based on MAGI, so we have to understand how the calculation works. Update number 2, determining RMD factors if you were born after 1959. Remember, the RMD start age is changing from 73 to 75 starting in 2023. So are you picking the correct IRS distribution factor when projecting your RMDs and planning for Roth conversions? And update number 3, how to estimate your state tax deduction. It's a big deal now that the SALT cap has been raised up to $40,000 from 2025 through 2029 under the One Big Beautiful Bill Act. People are looking to maximize those state tax deductions and get the most benefit as they can out of the OBBBA years. So if you're already a member of the Personal Tax Planning Template Program, you can log in and check those update videos out at your convenience. And if you're not already a member, lifetime access to the Personal Tax Planning Template Program is available for a one-time access fee at the link in the description below this video. Recent comments from members regarding value they've received from the program include, Justin, I watched the video and it does a great job answering my question. Thank you very much. I love your work. Or this member right here, by the way, I've been really enjoying the tax-related courses. You're doing a fantastic job. Keep it up. Or this member right here, thank you for the detailed explanation and quick response. I couldn't say enough about how much I've learned from your class and all of your awesome videos. Your purchase of the Personal Tax Planning Template Program helps out the channel and provides you with a tax planning and training toolset that you can use throughout your life to help minimize your taxes and maximize the after-tax cash flow that remains in your family's pocketbook. So it's a win-win for everybody. As mentioned, lifetime access to the program for a one-time access fee can be found using the link in the description below this video on YouTube. So that's going to be it for today's video. Thanks everyone for watching, and I'll see you next time.